History suggests that one big day in stock markets is more common in bear markets than bull. But what is really the number we should be looking at? The answer is 5. That's the number of months that the Federal Reserve may be pausing Fed hikes for. If they do so, what happens next with soft landings and recessions in 2024 might surprise you. Today we cover those stats, facts, and figures along with JP Morgan's risk to the upside on markets. Yes, everything's been melting up, and in many ways, it kind of was expected based on the stats. But as we approach one of the key levels, we're starting to see a little bit of weakness. We've also filled the gap on Tesla, approaching now a downward trend line, and of course, the Russell 2000 hit that critical 181 level we've been discussing. So with yields in focus, seeing whether we can make new lows, and of course, maximum pain coming, this Thursday is usually one for the volatility books. Join us as we cover stocks, commodities, and cryptos together. Well, welcome back everyone to the Daily Show where we talk about markets around the world. We've been doing this now for well over 3 years and we've got so many of you following. So make sure to subscribe and smash that alert button. It really helps out the channel. We'll be covering the macro, the lead indicators, and the hottest charts, but let's take a look at this day in focus. Some stocks were up, Tesla notably filling the gap, which is really great. But some of the leaders, Microsoft, Nvidia, and some of the semiconductors were moving down. Just a quick reminder, we've announced our new free weekly VIP newsletter. We're just doing a beta access for it right now, so it's limited spots. All you've got to do, link in the description and the pinned comment down below. Sign up, it's name, email, it's that simple. Get onto it. There's going to be some great information coming out over the next year. Let's move over though to the stats, and this one is a doozy. This has to do with VIX expiration, and what a great find here in terms of what's happened in the recent kind of 6 months from VIX expirations. Take a look at this, see if you can spot the pattern. The pattern generally has been that after VIX expiration, we've had weakness coming through the market soon afterwards. Here are all of the times we've had the VIX expiration. Some are bigger than others. Of course, notably the last 2 have been massive. But it's something to keep in mind as we've approached the key resistance or supply zone on the markets. And we'll look at the charts a little bit later on to see whether we've seen the first signs of weakness yet. More importantly, though, I want to talk about history stats, and these ones are big. Here is a stat that I didn't even know until today, but it's a great one. And that is basically that if we see 5 months of the Fed actually sitting, that is, they haven't actually raised rates, it tends not only to be the number one hike in terms of that is over and the post hike, but it actually has never gone over 5 months in history. So we've never seen a pause for over 5 months without a cut afterwards. And that brings us into the discussion of whether we're going into a soft landing or a recession. Of course, of the last 14 cycles, 11 of them ended in recession. And we've already talked about how the stats kind of go with this. We usually see kind of like a really hyper market that goes absolutely crazy. Then all of a sudden, we get a sell-off after the rate cut actually comes through. Remember, the Federal Reserve does not rate cut out of the goodness of their heart. Usually it means something is broken underneath. So could we be looking for a rally into maybe January of 2024 and then possibly a really scary 2004 in terms of up, down, and all around? It seems likely based on the stats alone. Here's a bit of a chart showing you the change to interest rates in the future and what the market expects the Federal Reserve to do. We've been talking about whether we get a Q1 rate cut or a Q2. History would suggest that somewhere in here is probably where it's going to be. Of course, Goldman Sachs famously came out this week and last week saying it's going to be Q4 of 2024. Which one do you think it is? We'll put a poll up soon, so make sure to subscribe and check out the answer for that, and we'll see what you guys think. Let's move over to whether we've seen the last of the rate hikes. Usually we can tell by following the US 10Y, which we'll look at later on. Usually the 10Y leads, that is, it starts to fall off. And we've already seen what we call the first time frame change of trend for the US 10Y towards the downside. So if history is correct, we would be looking at the last rate hike in markets. And of course, this has famously already been said a few times before, but the stats are starting to look that way. So why do we need to be worried about a rate cut? Well, it has to do with, again, going back through the history. And you're probably sick of that word already. But it has to be with the average of 195 days usually to find a low. And actually, during all of these times the Fed has cut, we've usually had really bad sell-offs in markets. Now, of course, there are outliers to that, notably 1980, and there are some that are worse and some that go for longer and some that go for shorter periods of time. Take a look at 2020, 1974, and 1987, only smaller corrections. But something to keep in mind and keep an open mind in 2024, because I think that's going to be one of the big things we look at. All right, so you might say, well, the SPY is going ballistic and it's so aggressive, it has to pull back and it's not going to do well. Well, here's where there's all these different stats, and there's actually quite a lot of statistical points for this. This is the S&P after 4 unfilled gaps of over 0.5% in 3 weeks. So basically showing us a huge thrust in the markets is going on. Well, the stats would actually say that a week later, we're still positive. 2 weeks later, starts to get a little bit dodge. 2 months later, still 78% of the time. 3, 6, and 12 months, very bullish and very aggressive. So for a bull out there, considering that we've had those swag thrusts as well, and the double swag thrust, which really suggests bull side, you can see why it's so confusing in the markets right now and why we need to focus on the price action that we're seeing here and now. Possibly 2024 is going to be a very trading market because we're going to see up and down stats all over the place. Let's have a look at the Russell 2000. This really showed us that we might have been finding a low for the Russell recently. I have seen a few comments out there stating that, well, you bought these stats up last year in November and the Russell didn't do so well. Hey, a stat's a stat. That's the kind of read we were getting. And while we weren't getting this exact same read in terms of 52-week lows followed by 4-day massive gains, we were seeing other bullish statistics. And you'll see what I mean about the Russell. It does tend to have this nice December into January run that happens fairly consistently throughout the years. When we get a read like this, we usually go 1 week, 2 week, 1 month, etc. into the bullish side. And you can see that the 6 and 12-month stats are quite compelling. A lot of these charts, by the way, are over on our X account. Links in the description down below. If you don't know what X is, it's Twitter, and it's been renamed. I'm sure most of us out there know that by now. Let's talk Russell 2000. We are, of course, now rallied back to this point, so let's draw where it is. We're basically at this area here, and this tends to be around that period of time where we base off for the Russell. Now, if we see price action basing, and we see, let's say, a rally followed by a pullback followed by a rally, it's going to be hard to really ignore the December, January effect that tends to happen with the Russell 2000. And look, let's face it, the Russell is so far behind some of the other markets right now. It's absolutely ballistic. Everybody's talking about this one as well. What is going on with the options volumes happening on the Russell 2000? We first noticed this probably about a month and a half ago. Huge volumes, both in the call and the put side. This is just call volume, but you can see how statistically massive it is in comparison to any of the other years, really all the way back to 2014. This is serious volume and serious option work going on in the Russell, and we'll have to start paying a lot of attention to Russell volume and options to figure out whether we can get any more information. Here's the Russell 2000 coming into this week's $1 trillion options expiration, which is, of course, the Opex. And you can see basically what tends to happen, percentage changes each week, and what happens in each year after the Opex expiration. So again, some interesting stuff going on there. History may suggest that, again, it's the bullish side, but option expiration week actually is usually not so good. So this is the option expiration week. This is option expiration day, which would have been the Friday. And then, of course, the week after is where the stats start to get a little bit better, and that's where you get into that 71%. So are we looking for a pullback here in the Russell coming into this Friday? And isn't it going to be actually the Thursday that shows it? Here's the Dow as well, just to have a look at some different stats. Again, more of a 50-50 followed by about a 57% bullish side stat the week after. So some interesting stuff coming into this week's Opex, and of course it shows you what's at stake. We'll look at maximum pain a little later on. Equity put to call ratio, a lot of people still scratching their head. How'd we melt up so hard? How are we rallying so hard? It's a mixture of stats and also too many people going negative. We will get the new sentiment reports coming out very soon, so we'll have them in our next video, so make sure to subscribe and we'll see whether that's gone super bearish again. But we are seeing a huge amount of puts that have been stuck in the market for this week's options expiration. Bullish percent close. Now, if this does end up getting above 70, that's going to be a huge bullish sign for continuation for the markets. When you get above 70, you can sit there for a little while, and that usually means there's a little bit more rally to go in terms of thrust. Are we there yet? The answer is no. Has this already shown us positive signs? Absolutely, yes, it has. And of course, we've been following it. Underneath 30 was a big read for us to start looking towards the bullish side. And as it turns out, that's exactly what did happen. S&P 500 performance after huge bullish days, 7 days in a row, 8 days in a row, 9 days in a row. Stats since 1950 would suggest that we're going to continue melting up. So we have to keep an open mind to that. Although we're at what we call a resistance or a supply zone, we don't know. That's the one thing. We haven't seen enough structural creation here. And if you are going towards the short side, you're going to need to risk mitigate pretty heavily because there could be a chance of significant further rally squeezes just in case. One of the interesting signs that was also possibly telling us that maybe rate hikes have stopped, and again, we don't know it, we're just kind of speculating here on this, is that utilities insiders have stopped selling. And we saw a massive pickup in utilities by the market as well on the day of the CPI. It went up 4%, which is a big move for utilities. That's kind of suggesting that maybe we have seen the rate hike end. Let's also move over to what's going on. Doesn't tell us what's broken though yet. And I'm sure there is something that's broken. This is gold. We know that we've been in a bit of a squeeze cycle. I'm just bringing this in so everybody can see that gold has got bigger players now buying it up. Someone is on the short side. We know of that because net positions were negative. Since this 1860 read, we went over 2,000. So obviously it's been going very, very well so far. And gold stocks, which we'll be looking at later on, just showed an island reversal towards the upside. So could they be one of the better performance over the next couple of months? It's certainly possible. Here's some percentages for the rest of the year. 27-3 in terms of bullish rallies that usually come through from November 15th to all the way through the end of the year. Christmas cheer could be here with Thanksgiving. And of course, that's the stats that we see. We also usually get a bit of a down in the overall yields from November 6th to 26th. So that seems to be happening as well at this stage. Here's usually how it ends up playing out. We get the Opex expiration. Maybe we sell off from around this date here. And we usually kind of float down a little bit and then get a nice rally coming into the end of the month. Will it be the same in 2023? Well, of course, we should be looking at the structure, which we'll do so soon. Lots of stats here, but let's go through some big dark pool trades that have happened. First up, we've got gold miners. A lot of activity on gold miners, mostly to what looks like the bullish side. We've got gold miner bulls here. We've got some big trades in biotech, which came through. Now, is that a take profit? I don't know, but certainly a huge trade coming back into biotech. Biotech's going to be one of those industries that if we have seen the end of the rate hiking cycle could do quite well. Obviously, it could also benefit from AI, although most of those companies do make no money and require buyout leverage after. Here's another gold miner that's going through. And of course, we've also got the dollar position. So it's suggesting that we have sellers coming through on the US dollar and that this move to the downside could be real. And again, it could be weak US dollar moving forward through the next couple of months. Do you agree with that statement? Do you think the US dollar is done for and it's going to start dropping off? That doesn't mean, by the way, it's over. The US dollar is still going to be the strongest currency in the world. However, it might be time for it to find a little bit of weakness in the wake of potential cuts. Let's move over to unusual trading activity. First up, I want to look at the options. This week is huge. I'm telling you, there's some massive options going through. We saw like a 47 million read. Now we've got a 45 million read. It's actually bringing the average options volume up. We're almost close to 40 now. That was like 39.5. 57% calls. So again, getting very bullish, and 43% puts. So we're starting to see a huge stacking of the call side. Some notables here, lots and lots and lots of positions. I mean, I would say Target was absolutely phenomenal. We were talking about that in the Market Masters Club. Links in the description down below if you're interested. But that ended up doing a 17.8% return. And that just shows you that sometimes markets can oversell the position. Obviously, it's had a horrible year, horrible, but it did show some base formation. Technical analysis really showed that one. 17.8%, what a session for it. Beating my expectations for the day for sure. A lot of other big volume sessions. You can see here we had things in a lot of hyper stocks. SE as well, notable, 3.39 times normal volume. We also got the Russell 2000 getting huge trade both on the call and the put side. So really strong trades there. And Tesla now starting to stack on the call side. So again, Tesla's currently in the trend up, but we did start to see a little bit of weakness. Let's move to rotation. Clean energy doing best, solar doing well, and of course, regional banks. All of those beaten down sectors doing quite well. I'm surprised to see biotech not coming through a little bit more, only up 0.1% on the session IBB. But yeah, maybe its time will be soon. It does have an interesting chart on the actual screen. We'll look at that soon. 10 was the best performer of the last 5 days. Regional banks, clean energy, semiconductors, home builders, and metals. I really enjoyed metals and home builders recently. It kind of shows you that maybe we are in a commodities boom that's going to last, on average, I think they last about 7.5 years, probably about 2.5, 3 years into it. Could they get a little bit more interesting? I'd say they could. But home builders is one that usually shows us that the actual market is significantly recovering. So we'll be watching that in signs of weakness as well. Advanced decline did drop off significantly, showing us there's some weakness underneath the hood at this resistance. And of course, our other indicator that hasn't really told us anything here about BOFA, high yield effective rate. That didn't really do anything to worry us about the market at this stage. So we'll be looking to see whether that one has signs of impending weakness. Put call ratio showing more calls coming in again. Put call ratio dropping well under the 1 rating. So again, we are seeing a stacking of calls happening. Percentage of stocks improved, but not by much across most of the major metrics. And the VIX continues to get crushed on down back into the 14 territory. Remember, around 12 to 14, you've got to start saying, well, we can be cautious in these areas and just, be patient. You really want to be buying when others are fearful. And we saw that when we got that 20 plus read quite recently. Let's go over to the yields now. We're looking for new drops on yields, 20-year, 10-year, 30-year, and even 2-year to new lows. Set alerts at the lows. That's going to be an important factor if you are a bull in the markets. But do remember, the yield cutting is not necessarily the greatest thing. One of the great combos to have on your charts is going to be a US 2Y versus US 10Y. If this goes underneath and uninverts, which of course it's not doing at the moment, it usually tells us that we're only around, I think it's like 4 to 6 months away from an official recession call. Now, whether it's a soft landing recession or a real recession, who knows? But either way, the market will still probably get pissed off. So remember, under 1%, that's what we're looking for, and we have not got that yet. Treasuries didn't have the best of sessions, down 1.4%, but still looking decent on the structure. I could see them hover for a while. Corporate bonds, high yield bonds, both down on the session, but again, they're just kind of like around these resistance areas. They've had a great rally. I wouldn't say there's too much to look into that. And equal weight market had a nice rally in it. This is the equal weight S&P 500, had a nice rally in it and then dropped off near the end of the session. So there's a bit of a wick on that, but yeah, well above its trend line. And of course, it's rallied pretty hard. Let's move over to some other things. Liquidity. It looks like the central bankers are still injecting. We've almost got a new high here from the Fed read, and this is the secret tools that they're using. And then, of course, we also have the worldwide central bankers injecting something. I still think something's broken, but hey, this is what happens in the world at this stage. The central bankers get the juice on. Let's move over to Dow Jones Transportation Average. Nice rally, then exposed into the short. So, of course, that's a big weak rejection. Certainly a little bit of a cause for concern. Does home builders have the same thing? It does. So showing that we may have exhausted this run. I would set alerts above here. If we end up getting a closure above the DJT and home builders, I would say we keep rallying for a little bit and really push that narrative of squeeze. But some signs there of a bit of an issue. Over to the commodities market, we've got iron ore doing quite well. Copper obviously holding its own as best it can. Copper looking like it's trying to break to the upside at this stage, and we've mentioned that for about a week. The US dollar making back some of what it lost, but that's pretty normal. It could easily get back up to like a 104.85-ish zone and then still sell off. I just think it's a little bit of a basing formation after what was a very aggressive sell-off. What about gold? Gold absolutely did exactly what we wanted. It moved to the upside. It rallied into this zone. It's now changed trend on very small time frames. And what it looks like it's trying to do is probably come back into this zone here. So I'm going to see how it reacts to around that 1945 to 1947 zone. That's where I could see rebuys come back in for gold, and certainly an interesting chart. Quite a good one. And if you looked at gold futures, they had a fantastic trade on them around the CPI announcement. It was a really serious trade. Now, let's move over to oil. So oil ended up having too much problems with this supply. A few members of the Market Masters Club were looking towards the negative side. I obviously had the bullish side in mind this week with a 20 moving average 81 to 82. But when we saw what we did with yields, unfortunately, if yields are dropping, that's never a good thing for oil. So there was a good short actually in here if you got it. I like the long here. I like the short here. And the long just got broken even. So unfortunately that happens. You could have taken profit here if you wished to. I still liked it up to that zone. But at this stage, yeah, looks more negative than positive. And it just shows you again that maybe it's worthwhile usually considering going in the direction of trend. Sometimes I like to fight it, but usually you're probably better off not. Let's move over to Tesla. Filled the gap. Nice. That's achieved. Next move, questionable. 250 could be like a resistance as well, just psychological, also a supply over here. I'm not sure. I mean, the trend is up on Tesla, but I could see some weakness coming back into this pair now that we've filled the gap. And I think that that's also going to be a reverse fib. So if you take like a fib from the high to the low, you're going to be in the golden pocket. There's a lot not to like about this zone, even though the trend is up. So I think some caution on the Tesla trade. IBB, I mentioned the biotechs, they have been improving and we have seen some signs of pretty strong recovery. Obviously, that's not a perfect trend line or anything, but what you can see is that it's finding that resistance. I'm looking for it to get through here, get through 124. I think there could be some serious runs on biotech if we do see recovery of the bottom line, that is the Russell 2000, etc., in the coming months, but no signs of that yet. And the Aussie 200 failed to break above and close 7100. So it's really in the focus of the S&P. So this is the Australian market. It's going to be really focused on what is the S&P 500 doing. Here's the Russell 2000. So that's trading about 1800. It ended up making it to 1831. And it's actually found all of this previous support, this supply. So this is supply, support, becoming resistance. You've got multiple moving averages in there as well. You've got the daily 200 sitting there, and you end up getting a shooting star. So on the surface of it, you would say, well, that looks weak. So what we need to do is we need to say, okay, well, what's happened on the smaller timeframes? Have we really seen structural weakness? And the problem is that we don't really have enough information fully yet. You could argue that as this market at the time of this recording is really facing its first hurdle, this support here, if it keeps moving down to the downside, gets through there, rally is probably going to be met by short time frame trade down. And a lot of people are going to be focused on filling this thing here, which was that huge CP, some people calling it CP lie. I like that one. CP lie, this full CP lie movement. And effectively, this is the area where we'd be looking to fill. So yeah, that's a zone that I think a lot of people will be looking at the rebuy on Russell. Have we got there? No. Are we seeing signs of weakness? That is the first sign if it keeps falling just a little bit more. The Qs also facing their big resistance, which everyone I'm sure is looking at. And that's where we are with that one. And of course, if you move over to the NASDAQ, you can see the way it's reacting. Again, let's go 10-minute chart, small time frame. A lot of you request this. And let's have a look at the structure. It does have some structural changes. We've got weakness down to this period. We've obviously got the strength culminating in this big high. And where are we right now? We're right on that support. So we need to go a little bit lower. Then I would say rallies to be met by sell demand, looking towards that 15,500 kind of fill level to 15,550. Let's move over to the Qs versus SPY. The reason why I'm kind of saying, need to look at this, look at the Qs versus SPY, back to a new all high. It's obviously melting up. So again, this doesn't matter. But a lot of people have been focused on going back through history on this and saying, look at this, look at 2000, check that out. I wouldn't really use it anymore. I think that this, although the Qs deserve to be a huge market cap in comparison to the SPY because they are a huge part of the economy nowadays with the internet and obviously everything that's going on with the AI revolution, this is still a very interesting ratio that we are seeing on the charts. Let's have a look at the SPX. So that's the S&P 500. Still in that resistance zone. Let's go to the 10-minute, 15-minute chart. We know that we've started to see potential turnover. Some people will be saying this is a head and shoulders with a neckline there, looking towards weakness and a fill of this at least initial gap, which is 44.20. Yeah, it's possible. Let's go to the futures market and have a look at the futures market. Again, we're not quite underneath these key levels. So notice here, we've got this demand. Where are we at this time of recording? Right there. If we fall a little bit more, I'd probably expect it to buy off this level here. and then maybe move towards the sell. So look, key level, if it does find buyers here and then keeps pressuring, don't be surprised though for short squeezes to continue on, maybe all the way up to the new highs of the market. But as we said, 45.12 to 45.20 was our level. And if you were fortune favors the brave trying to short that zone, you might have done okay, I guess. Let's move over to Bitcoin now. We've kind of cautioned against going negative on Bitcoin at this stage, and it was another beauty rally. This is the typical of the crypto, what it likes to do, 10% in less than pretty much 24 hours. We're back up here in the highs. Most people looking at that 39.5, or at least we're looking at 39.5 or 46 as the zones still for the bullish side for Bitcoin, and Ethereum is coming back as well, trying to get through that 2150 resistance. So yeah, don't bet against crypto just yet is the way we're looking at it on the charts, but of course we'll be flexible in our concepts as we can go. Let's have a look now at maximum pain for this week. So maximum pain's creeping up. It's now sitting at 433. Don't pay too much attention to the number itself, but do pay attention to where the calls and the puts sit. We are sitting at 449. Where would I think Wall Street or the biggest players would like it? A 440 close would be pretty sweet for them, and it would make them a lot of money. So if they manage to do it, hey, all power to them. Of course, we do know that Thursdays, which is the day coming up, is usually the most volatile of the Opex weeks. Then Friday can be a little bit less volatile. We've seen some stats before, so keep on the tail of those. In terms of everything else, there's not too much big information coming out, except for now the trillions of dollars of options expiration. So don't worry too much about that one. And as a reminder, we have launched our free VIP weekly newsletter. All you need to do, links in the description down below, name, email, that simple. And remember, the spots are limited initially. So make sure to sign up, links in the description. Thanks so much for following, set the alerts, subscribe to the channel. We'll see you in the next one, and hopefully you enjoyed today's session. Bye for now.